You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. Now I'm sipping on this whiskey, got one chance and it's risky, so you can't play around. And I got my team behind me like a background. I don't never back down, picking up the slack now. Now I'm focused, keep on grinding for my stacks now. I'm feeling lost in this ocean, where's a lighthouse? I keep on swinging for the fence and I ain't strike out. And yeah, that's how I'm feeling, yeah, that's how I'm feeling now. We're not here for a long time, yeah. It's 9 to 5, it's a long grind, yeah. A lot of to success, it's a long climb, yeah. Now I'm sitting here making up for time, yeah. Man, I took so many losses that I lost count. I didn't know what I was made of, but I found out. And this life will blindside, you better look out. These haters wanna see you fall and get you took out, yeah. Cause I fell on my face, and this life is a race. I keep on checking my place. Now I'm riding for my team, you can tell by my plates. And this life just threw a hook, it caught me right in the face. But I'm getting back up, I'll do whatever it takes. I'll climb a couple of mountains, I'll swim a couple of lakes. Don't got time for the bitching, don't got time for complaints. Now you going through some shit, now tell me how does it taste? You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. Now I'm living with my choices, I just own my mistakes. Cause I'm screaming fucking hand out, I ain't searching for breaks. But I'm barely treading water and this life is the lake. Now the pressure keeps on building as I'm raising the stakes. I ain't looking for advice, now I'm looking for space. Now I'm dealing with these losses, but I know I hate the taste. Now I'm sitting back, I'm thinking as I smoke it to the face. Now it's time for these apologies, the time is too late. So bygones be bygones, I'm on business with a tie on. So fuck a shoulder to cry on, I'ma get a hopping like Zion. Let's raise a glass, I'll toast that. Reminisce, we roast that. How I wrote them and ain't wrote back. I'm never flimsy, the goat's back. So I don't feel bad, no not at all. When a lot of years, write a lot of calls, a lot of birthdays without a call. Ain't got time for that, so fuck a fraud. You ain't there for me, I ain't there for you. You won't bleed for me, I won't bleed for you. All the hard times I lived through, keep moving, gotta get through. I got goals and cash I gotta get to, all these memories that I flipped through. If you can't relate, then don't judge. I'll stand my ground, I won't budge. I'm sitting back cause I burn buds, I swear to God this life's good. You don't know all the shit that I've been through, all the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through, thinking about all the shit that I've been through. You don't know all the shit that I've been through.
Make sure you guys check out Paul P Music. The song is Living Through. Check him out on Instagram and Spotify.
Thinking about all the shit that I've been through.
Paul P Music, everybody. Hello, fellow retail investors. I'm the Butcher of Wall Street, Marcel Kalinovic. Welcome to the Silicon Valley 5K first annual bank run. And for the first time, the Federal Reserve is losing money. Thanks to interest rate exposure, the central bank is losing money for the first time since, 1915 or so. And the Federal Reserve was designed to make money for the government from their monopoly on issuing currency. And they did generate profits from their inception, which are then sent to the United States Treasury, which is my ex-girlfriend, old Yeller here. Every year since 1916 until this past fall. And the Federal Reserve, in an unheard of turn of events, is now suffering operating losses of about $45 billion since September of 2022, to clarify. In September, there was a massive interest rate risk created by the Fed, as you guys may all know. So if you hear some rain in the background, hear my dogs, it might be tornado season here in the Chicago area, let's put it that way. So My stream gets cut out because I probably went to the basement or I lost internet. But now the Federal Reserve is losing around $7 to $8 billion every single month. And that's because there are trillions of dollars in long-term investments yielding 2%, cost around 4.5% to 5% to finance. So the Fed is going to have negative equity in this capital, and operating losses will continue to increase as the equity capital deficit continues to increase. July of last year, the Feds discussed the possibility that the whole financial system could incur substantial operating losses as the Fed increased interest rates to fight inflation. And they tried to downplay the importance of the issues, but they said it was a mandate that is neither to make profits nor avoid losses, which is nothing more than a deflection, which is apparent to anybody that's familiar with banking. The Fed avoided policies that would be used to expose these kinds of losses, and member banks could previously borrow from the reserve banks only by posting specific collateral. And nowadays, I'm going to show you a lot of that collateral, and that it might be a lot more obvious than you think. The Federal Reserve Act required the loans to be backed by short-term self-liquidating bills, if you will. We call it commercial paper or commercial notes. Over time, these loan collateral requirements changed, but as they did, the Fed has introduced new policies to protect it from losses from the lending banks to the member banks. And Congress tapped the Fed for emergency loans, basically through the RRP, the Reverse Repurchase Program, and the Fed window to prevent a wider financial crisis, and is looking for guarantees to protect themselves from losses. Right? Instead of lending directly to these banks, the Fed has proposed that it lend to different Reconstruction Finance Corporation, which could then lend the proceeds to the newly opened banks. You hear that hail coming in. So this was a way that they used this window, the Fed borrowing window, in order to loan money to the banks, which has to be repaid. And because there was an explicit federal government guarantee that would protect the Federal Reserve from losses should a newly reopened bank fail, that helped prevent the further issues so far with the first annual SVB and Signature Bank run. The special lending program was used very heavily in 2008 and 2020, and they were undertaken only after the United States Treasury allocated funds to absorb losses that the Fed might incur from these emergency loans. And on March 12th of 2023, the Fed issued this special lending facility once again, and there's been $25 billion of losses incurred so far by this new program, which will be covered by the Treasury. So the United States Treasury and Janet Yellen telling you that these are not government or taxpayer-sponsored bailouts are absolute lies. These are 100% taxpayer-sponsored because they're all covered by the United States Treasury, which receives its money from us, the American taxpayer. I gotta close this window a little bit because I'm getting hail in my house. I wasn't kidding when I said it was tornado season in Chicago. So this Fed borrowing window happened in 2008 before the market crash, and in 2020 before the market crash as well. And avoiding these credit losses by the Federal Reserve is a requirement that Congress added to the Federal Reserve Act in 2010 after the 2008 great financial crisis. They added it to the Dodd-Frank Act to establish policies designed to ensure that the emergency lending program would protect taxpayers from losses. So the Federal Reserve Act requires the Fed to avoid taking these kinds of losses, these credit losses, that could have an impact on taxpayers, again, because we are fucking paying for it. It makes no mention of losses from interest rate risk exposures, which is exactly what's going on here. So the Federal Reserve weaseled their way into another emergency borrowing window to bail out the richest people in the world based in and around Silicon Valley. And the people who authored the Dodd-Frank Act had never imagined or purposely left these loopholes open. Monetary policy was all but basically sure to generate profits for the Fed prior to 2008. And that changed once they started paying banks interest on their reserve balances and making these large open market purchases on treasury bonds, long maturity treasury bonds, and MBS, mortgage-backed securities. So these are now unrecognized taxpayer losses. These are unrealized taxpayer losses that are becoming realized in a way that Congress never either intended or imagined at a magnitude that neither the Congress nor the Fed could have ever expected. And that being said, the Fed has now increased their balance sheet by $400 billion in the last 2 weeks, which is almost $500 billion in the last 3 weeks, which has undone almost 75% of all quantitative tapering that has happened so far. The Bank Term Funding Program, this Fed window, is over $75 billion in its first not even 21 days yet. It hasn't even been 3 weeks. And the discount window usage last week was around $110, $115 billion. But again, as I said in my last stream, this isn't big quantitative easing, okay? What the Federal Reserve is currently doing, as I just stated, is lending to these banks using its balance sheet increases. And when they undertake QE, they primarily buy treasury bills and mortgage-backed securities from the banks and financial institutions with no time period defined on selling them. And they do this with money that does not exist. Therefore, it is an inflationary act. And so a bank would sell the bonds to the Federal Reserve, and then they would print money out of thin air from the Federal Reserve to the bank. The bank then lends out this money, and the money that has been loaned is then used to buy things by creditors and borrowers to stimulate the economy. But that's much different from lending money to the banks, which is currently what's happening, in order to allow them to meet their immediate financial obligations. That's why we have Janet Yellen warning that the next crisis could come from shadow banks amidst regulators, and regulators must act. She said this past Thursday, Thursday, March 30th, that banking rules need to be tightened after the recent failures of Silicon Valley Bank and Signature Bank, while warning of structural vulnerabilities that must be addressed in the shadow bank sector that includes things like hedge funds and money market funds. Hedge funds are extremely over-leveraged on short positions, and money market funds have nowhere to put their money except for the reverse repurchase program. We've heard back in 2018 and in 2020 and 2021, Yellen told us that a rollback of bank capital requirements and stronger supervision for smaller and mid-sized banks with assets under $250 billion should be reevaluated. And recently, just a couple days ago, she said that, quote, anytime a bank fails, it is cause for serious concern. Regulatory requirements have been loosened in recent years. I believe it is appropriate to assess the impact of these deregulatory decisions and take any necessary actions in response. But Yellen didn't just figure this out. She's known this for many, many years. She also said, but the failures of 2 regional banks this month demonstrate that our business is unfinished, adding that the U.S. financial system is now considerably more robust to shocks than it was during the previous crisis. What a lying bitch. That's all I've got to say. That's why we broke up, by the way. That's why I'm no longer with old Yeller. This fucking lying bitch. So she made no proposals whatsoever to tighten regulatory and supervisory standards, and she said that any next steps must take into account the, quote, health and competitiveness of our vibrant community and regional banking institutions, which could face an outsized impact from more regulations. And in the speech, she called for tighter regulations of the shadow banking sector, which includes over-leveraged hedge funds, crypto assets, and money market funds. Okay, because there are hardly any rules and measures in place to reduce these types of bank runs. There are very few capital and liquidity requirements for banks, which like there are in the traditional banking sector, and deposit guarantees by the FDIC to reduce the likelihood of these financial runs. However, she goes on to state, and I quote, yet the financial stability risks posed by money market and open-end funds have not been sufficiently addressed. Money market funds in particular are vulnerable to financial runs and fire sales due to the first mover advantage. If you guys have ever seen the movie Margin Call, it's a lot easier to be first, period. So first mover advantage established incentive for investors to redeem at the first signs of problems. And in the context of money market funds, means that first redeemers can exit the fund at 100 cents on the dollar per share, while those who wait may be subject to reduced market values and take a haircut on their money market fund investments. So this creates a huge incentive for investors to redeem their money from these money market funds and hedge funds, which can lead to financial runs and panic sales. So this is exactly what happened during the COVID crisis in March of 2020, when the record outflows were around $255 billion just pouring out of mutual funds. And at the same time, hedge funds had nearly $10 trillion in gross assets in 2021. She told us this just yesterday, and she also told us this back in 2021 while testifying in front of Congress for the CARES Act. Yellen said yesterday, leverage can support economic growth, but excessive leverage is dangerous, in reference to hedge funds. It can add fuel to fire sales by triggering a negative spiral of margin calls and rapid asset liquidations. These fire sales can transmit stress to other market participants, she said, including large and systemically important banks. She continued to say that post-crisis banking regulations have helped reduce the potential spillovers to the banking system, but spillovers from these fire sales to other market participants remain a risk. And I'm going to show you all of that right now, from what assets they're going into, what margin calls she's talking about, and what financial institutions are in trouble. Let's just dive deep right here. This was Treasury Secretary Janet Yellen and Fed Chair Jerome Powell testifying on the CARES Act and pandemic recovery. And this was in September, I believe it was September 21st of 2021. Check this out. You guys got to hear this. Janet Yellen knows exactly what's going on. So does the Fed. And they have been playing dumb all along because they know that we, the American taxpayer, are going to be the ones that has to foot the bill.
Shock to the U.S. and global economy in the last 2 years. Beyond COVID, what do you assess are the most significant systemic risks or threats to financial stability in the U.S. and globally?
Now remember, this is around 2021, September of 2021.
When I think about systemic risks to the financial system, I always think about cyber risks, really more than anything else. We have a very highly capitalized banking system, one that is much better at measuring its risks, so that more traditional making bad loans, losing money, and things like that, that'll happen, but the banks are really well fortified against that. The risk that we haven't really faced the full brunt of yet is a successful cyber attack on a financial institution of some kind, be it a financial market utility or a bank or another financial institution. And we work closely with Treasury and other agencies all around the country on that. You never have the feeling you're doing enough, but it's a very high priority to be ready for it. But that would be the number one thing.
Madam Secretary, the same question for you, please. Other than the ongoing COVID-19 pandemic and the terrible economic toll that it's taking and the terrible health toll that it's taking, looking more broadly, what do you assess to be the most significant systemic risks or threats to financial stability?
I think there are threats to financial stability that have come from the growth of activity in the shadow banking sector. We saw some of those threats emerge during the onset of the pandemic. We have, for example, open-end bond funds that guarantee daily redemption, saw massive withdrawals by individuals who wanted to flee to cash, and that can trigger fire sales of assets with systemic consequences. The Financial Stability Oversight Council that I head has taken that up as a topic that we're looking at and examining. There are issues relating to hedge funds and the possibility of leverage there that can trigger financial runs. That's another topic. And more.
You can see Janet Yellen is saying the same old story just yesterday as she was saying in September of 2021, because they know exactly what's going to happen. She also said that yesterday that a run on one stablecoin can lead to panicked runs on other stablecoin, causing even broader sell-offs amongst money market funds, hedge funds, asset classes, stocks, equities, and financial institutions. She finished by saying, we're also exploring broader policy issues around the future of money and payments, including the possibility of a central bank digital currency. And meanwhile, these global banking regulators have been discussing stepping up scrutiny of how risks from systemically important shadow banks, hedge funds, and money markets could destabilize lenders. This is a serious problem, and it's something that we've seen right now, that we're seeing with Charles Schwab, as well as many others. You've seen runs on Silicon Valley, Signature Bank, Credit Suisse, and FTX, and many others, cryptocurrency exchanges, regional banks, and even international banks like Credit Suisse, and we're going to see that continue here in the near-term future. The bank runs are not over, and we are even seeing Charles Schwab seeing a 33% decrease in their stock price, and a low price that has not been seen since 1987. Charles Schwab stock price has not been at these prices since 1987. And Schwab continues to talk about their ability to handle these risks, and they state that they've got significant capital in case people wanted to withdraw their funds. But if they did, they would still have to set, if there was a large financial run on Charles Schwab Bank, there would be a great risk that they would have to sell a lot of their assets at a loss. And they would be able to do that, and they would take a lot of losses in the short term. It would realize a lot of losses for them. Real quick, I want to acknowledge Grandpa Barney for the super chat. Thank you very much, my friend. He says, thanks, boss, for even being here during the storm and storms of life. Much respect. Thank you, Grandpa Barney. You were too kind, my friend. But that's why we're here. We're here to discuss financial education and these issues that are happening in the real world, because as much as people want to pretend that politics don't have anything to do with the stock market and vice versa, they could not be more wrong. Geopolitical issues and macroeconomics have everything to do with the stock market and finance and our everyday lives. You're looking at Morgan Stanley stating Charles Schwab is vulnerable to a bank run, forced to sell securities at a loss. And they're right. Analysts at Morgan Stanley downgraded Charles Schwab Corp. On Tuesday, this past Tuesday, citing concerns over cash sorting and regulatory changes. Schwab CEO recently said that the company's banking unit had enough liquidity to cover 100% of its bank deposits without having to sell a single security. I don't believe that for a second. He states that Schwab's recent performance has not been up to. They state that with customers moving cash out of sweep accounts into money market funds at a rate twice that which the bank had been modeling, they really put themselves in a bad situation here. Charles Schwab was only betting on a 75 basis point increase by the Federal Reserve, and here we are several months later with 450 basis point increases so far. And that's exactly what's going on right there. Looks like Cyprus from Morgan Stanley told investors that Schwab's earnings are under more pressure than initially anticipated, and the company is facing $22 billion in unrealized losses due to these rising interest rates, what I just told you about. Right. Oh, and here you go. Despite Bettinger's comments last week, Morgan Stanley and I believe that Schwab Bank may have to sell securities at a loss to fund future withdrawals. And that's the end of the article there. But at the end of the day, I believe they're correct. Charles Schwab will likely take a massive short-term loss due to financial runs. But I do not believe that their brokerage sector, again, I'm not a financial advisor and it's not financial advice, but I don't believe that their brokerage arm of the company would be at risk. It would be the banking sector, the banking arm of the company, that would be at greatest risk. As we're seeing here, we've seen with the Lehman crisis, the downgrade of the United States credit rating in 2011 due to the debt ceiling issues that we were seeing, due to various issues then, and then the debt ceiling crisis again with massive spikes in USA sovereign credit risks. These are credit default swaps for the United States. And now we've got the graph here, the chart from Zero Hedge showing the everything everywhere all at once credit default swaps on the United States of America, sovereign credit risk are absolutely through the roof. And that's absolutely the case. This is the, before we move on to that, no, let's just move on to that. We'll talk about gold and silver shortly here. The S&P 500 market cap change. You can see that the top 15 largest stocks have seen the $1.8 trillion increase in market cap change year to date, while the remaining part of the S&P 500, the other 485 companies in the S&P 500, have seen a negative $21 billion outflow compared to the $1.8 trillion inflow. That's because these FANGMAT stocks, Facebook, Apple, Amazon, Netflix, Google, Microsoft, Nvidia, Tesla, are a very safe haven for over-leveraged hedge funds at the current moment. So there's been $1.8 trillion in inflows so far just to these alone. So the bigger picture here shows that, the dollar is suffering its second straight quarterly losses. Bitcoin's up 70%. Gold is up around 10%, even recently. Meanwhile, most stocks are down, with the majority of stocks are down, with the FANGMAT stocks being the few that are currently increasing in value. The NASDAQ was up around 8% in its biggest increase, biggest March advance since 2010. The Dow surged today around 209 points as well. And we're seeing a massive gamma squeeze here based on these zero data expiry negative delta flows in options contracts, because the S&P 500 broke above the 2065, 2070 collar call strike and rapidly unwound as stocks continued to squeeze higher. This is all gamma, and so that accelerates the gains even further. The S&P rallied all the way back up above 4,100 and such, and I think ended the day around 409, if I recall correct, on the SPY. But taking a look at the FANGMAT stocks, you can see that Meta, Apple, Amazon, Netflix, Google, Microsoft, Nvidia, Tesla account for all of the S&P 500's year-to-date return so far, mostly because the 80% of the money in the stock market that comes from large institutions is going into those stocks. They're up 4.6%. And the other 492 stocks collectively are down, around 1%. Okay. So watching these things soar back up, Microsoft was Meta was up around 2% today. Watching these soar back up is due to the ebbs and flows in the market, and there's gamma on the zero data expiry options that is currently occurring, because PCE was in for the month and it was only up by 0.3%. That's not great. That's still a 0.3% month over month increase in PCE, personal consumption expenditures, than where we were yesterday. But the stock market continues to believe that the Fed will pivot soon. At the same time, you're looking at here the bond market. Bank of America, basically this is the VIX for the bond market, and we saw the highest that we've seen since 2008 just a few days ago. Let me go back to the one-day chart. On the 14th of this month, we saw it go all the way up to 198.75, and we're looking at very much a similar trend now, with the ebbs and flows up and down about 4 times that we saw in 2007, 2008, before the stock market crash. And the VIX, the Move, Bank of America, Move Index jumped to 214. And we saw the same thing here in 2011, 2013, 2020, and now we're kind of tapering upwards and bleeding upwards on the volatility index for the bond market as well. Credit markets remain more stressed than they have ever before, even with the current rally that we're seeing. And the availability of money and lending is absolutely being destroyed right now. This is definitely in what the Federal Reserve wants to see right now. as yields increased on bonds. So market expectations against the Fed basically swung violently from a hawkish Powell surge to a post-SVB collapse, as we've seen with the SVB bank runs. And this is basically, we're looking at a coin flip. And so the short-term yield curve is ending a little more dovish than it began, leading to what we're seeing now, a melt-up, a current melt-up in the stock market. And it's only a short matter of time, as they continue to invest their money in these FANG-MAT stocks, that these issues with the shadow banking sector that we're seeing Janet Yellen tell us about continue to become exacerbated. We've got countries around the world like Egypt, which just joined BRICS Plus. We've got Mexico, Nigeria, and dozens of other countries lining up to join BRICS. And for the first time in many, many decades, the G7 is no longer the highest GDP producer, producing a conglomeration of countries in the world that has been overtaken by the BRICS countries. Take a look at this post here earlier from Charles Payne. Depositors pulled $1 trillion, mostly from large banks, over the past year. Billionaire depositors in the nation's wealthiest zip code, SVB, Silicon Valley, got a full bailout, ostensibly to save small banks, says Charles Payne. He says it looks like the plan worked, the real plan, because the deposits on small banks was over $125 in withdrawals, and actual deposit inflows to large banks was around 125 billions. The issue here is that these large banks are not immune to the issues with the money market funds and the over-leveraged hedge funds and stable coins that we're seeing Janet Yellen, the United States Treasury, and the Federal Reserve talk about right now. Excuse me. At the same time, we're seeing these inflows into these large banks because people believe that they're too big to fail. And while that may be the case, the government may have to bail them out. That doesn't mean that hundreds of companies aren't looking at the possibility of bankruptcy, and that a lot of these banks could have some serious systemic issues. That does not mean that money is safe in them, and that's why gold and silver is up at greater levels than ever. The fiat is at an end. We are at a point where the United States dollar is collapsing, even though it could be melting up for the short term. It is, on the long-term trend, collapsing, and the only way to save it would be, one, to issue a new fiat, which wouldn't last that long either, or two, issue some sort of other money that is backed by precious metals, silver and gold, which is exactly what the BRICS Plus countries are doing. But you're seeing the central banks talking about a new central bank digital currency, and they will implement the central bank digital currency after the stock market has crashed, after people lose all their savings, after people lose their homes, their cars, their investments, because people will be so desperate for the central bank digital coin. They will be able to put limitations on what they spend their money on, what percentage of things they spend their money on, how much is spent on food, how much is spent on the stock market, how much is spent on your car, your home, etc., and have an expiration date on that money. That's already happening in China, and it's soon to come to the United States, because the United States and the Federal Reserve will do everything they can to maintain their power. And Americans can fight against that by using by using credit unions and small banks that are not trading on the ISDA market and that are not as susceptible to the financial runs, such as you've seen with SVB and Credit Suisse and so on. That just because there's current inflows into big banks doesn't mean that it's sufficient liquidity to prevent them and save them from having the same issues and problems that we've seen at Credit Suisse. At the same time, you're seeing broker-dealers like Interactive Brokers change their terms of service in order to allow cash accounts, non-margin accounts, cash accounts, to borrow shares and lend shares on the share lending program without permission. That's one of the reasons why I changed brokers. I have multiple brokerages, but that's one of the reasons why I took my shares, my AMC and GameStop and other shares out of Interactive Brokers, because they made those changes. And you can take a look at their very own. I'm not about DRS. I think DRS is trash, but to each his own. As you can see on the new section C3 from ibkr.co.uk, it says that their stock lending activity or rights to use your assets is basically whatever the hell they want. They can do whatever they want. They can pledge, repledge, hypothecate, rehypothecate all your collateral, securities, and or other of your property, either separately or together with other securities, blah, blah, blah. You get the point. In the United States, they also made changes to certain cash accounts over a certain size. So that was one of the reasons why I had to immediately leave. And as you can see, the issues in the shadow banking sector are becoming more and more apparent every single day as the cost to borrow on heavily shorted stocks like AMC and GameStop reaches new all-time highs. Here's AMC, for example. I know this is kind of small, but new AMC's short interest percentage of the free float is now estimated at 25.05% by Ortex, with 129.37 million live short interest shares. That is forcing shorts to pay a ridiculously large average cost to borrow of 406%. 406% average cost to borrow on AMC, with 38.88% of the free float on loan and 25.12% estimated short interest, with 100% utilization. This has been going on for a long time because shorts are absolutely stuck in this position. Some people have been asking, oh, are you stuck in a long position? I'm not stuck in a long position. I've got shorts stuck in a short position. And it doesn't cost me anything to stay long. It doesn't cost me anything. My shares are sitting pretty right there. And I'll continue to look at unrealized losses until I can look at realized gains in my account. Massive, massive realized gains. Because until all my brokerage accounts look like a phone number, I'm not fucking selling. On that note, I got a little poem here that I wrote over a year ago. It's called I Ain't Selling Till They Fire Janet Yellen. Because I'm holding until Citadel's folding. I'll keep on going until they jail Steve Cohen. I'll not get rid until the SEC finds the FTDs they've hid. I'll not sell till I reach my floor, and until then, the world must know that our government is bought and paid for. Until that price is ripping, I know there's still a lifeline for Kenny Griffin. I'll be staying long until they admit the price is wrong. I won't liquidate until the SEC stops using work time to masturbate. I'll not make a toast until I receive a flying bedpost. That was for you, Kenny G. Tell your wife I said hi, your ex-wife. And when it's all done, and I'm rewarded for having waited, I'll use my tendies to make Chicago sophisticated. Thank you very much, everybody. MC, hey, thanks for the super chat, buddy. You're too kind. Appreciate you. I wanted to take a quick look back here. I wrote a new poem just the other day. I put it on Twitter. Maybe I'll bust that one out here shortly. But let's take a quick peek. This was the first video I ever did live on YouTube. Okay, the first video I ever put out. I did it some previously with Jackson Hunter and with a couple other guys on their channels. This was the first one I did. That when I realized that all of my due diligence led me to the fact that banks and the federal government and United States Treasuries are extremely over-leveraged, and there is no way out of this without a collapse of the United States dollar, many, many short hedge funds and family offices, many crypto exchanges, and so on, and prime brokerages, etc. And they're all going to need a bailout. That's why you always hear me say, Jerome Powell, get the fucking money printer out, because you're going to need it. And I will wait patiently until then. Well, let's take a look at this. This was the first video I did in August 24th of 2021. August 24th of 2021. We were saying the same fucking thing I'm telling you now. We saw ahead, we looked at the data, and we realized that credit default swaps were up almost 3,500%. We realized that inflation was about to become out of control, and we had to warn everybody we could. 5,000% increases between banks and holding companies, which are shell companies, just this year. So it's not that they weren't already out like in ridiculous amounts, but they've increased so much. This is for holding companies, trading revenue, and the amounts of credit credit default swaps and derivatives, mortgage-backed securities. All right, I think this is a little bit better as far as the microphone goes, right?
This is me in the past talking here.
Manage button to go and see.
As you can see here, at the same time, we were talking about $189,000.
Which is really scary because this is alone is $5
trillion in total derivatives liabilities, without taking into account naked shorts and synthetic shares, shorts marked as long, and everything else, every other way that they were hiding things on their books. This is all this stuff is directly from the Office of the Comptroller of the Currency, directly from the federal government, because they give us the data flat out right in front of your face, but nobody looks at it. And as a small business owner, I've been looking at this data for the last couple of decades now to specifically learn how is our economy looking, how is our country looking, and where am I going to spend my money? Where am I going to invest my money?
Let's answer another question.
See, as you can see here, this is from the Office of the Comptroller of the Currency, June 28, 2021, Bank Trading and Derivatives Activities Quarterly Report. We've been looking at this every single quarter. I've been looking at this for over a decade now, and every single quarter since then, I've been looking at it, and their derivatives have not gotten better. They are not able to wind these down.
And that, he's a man of 2.5 billion naked shorts. And again, that's just my opinion.
And the over-leveraging that's been occurring on the financial markets, on short positions of AMC and GameStop and many other stocks is ridiculous. I think I hear tornado sirens. Definitely hear tornado sirens. Kids are worried about me. They want me to go downstairs because of the tornado sirens. I'm not going anywhere.
You better go, bro.
I'm not
Get
going
out,
anywhere.
bro.
I'm not going anywhere. Unless my fucking roof starts getting torn off, I'm not leaving.
This here, look at, yeah, RK, that's right. It does help people get.
And again, in August of 2021, we were showing you the same thing. GDP, retail sales, consumer sentiment, the US dollar. Everything was down. The eviction moratorium was over. That was going to start increasing bankruptcies, increasing rent. Inflation was low. Inflation is transitory, is what the federal government was telling us. And we knew that was absolute bullshit.
An idea of the infinity. 5%.
Nothing has changed. Everything we've said at that time, for the most part, is coming to fruition. Everything that we've been looking at is happening right now, confirmed by CBO, by the OCC, by the Bureau of Labor Statistics, and AMC stock price and GameStop continues to get shorted and manipulated. Meanwhile, FINRA margin debt and the S&P 500 real values continue to increase. At the time, Bitcoin was still at 47.7, and we were calling for a drop in Bitcoin prices as well. That was when it jumped up to new highs. We've been looking at total return swaps ever since then. You can see what we said here. We said for a long time they've been using total return swaps with banks to short meme stocks and the meme stock ETF baskets into oblivion. This is a way to hide short interest percentages. Melvin and other short hedge funds got overexposed by shorting the stocks directly, not through the total return swaps, bringing the reported short interest on GameStop and some of the other stocks to around 226%. In addition, they used deep in the money calls to pull these short positions from Melvin and other short hedge funds to avoid those for them from going under. That's why Citadel Securities basically gave them a giant bailout, and why now Citadel Securities is receiving lines of credit from Bank of New York Mellon, bigger and bigger lines of credit from Bank of New York Mellon and other banks that act as their prime brokers. Because when overleveraged hedge funds like Susquehanna and State Street and Jane Street go under on these short positions, they're going to take down their prime brokerages with them. So basically, synthetic shares, rehypothecations are what's occurring right now. And that is not going to change anytime soon.
But looking at the video back then, we were right on the fucking money. And everything is continuing to play out. Although
Let's
on
see
a
what else we
longer
got
time
here.
scale than I expected, everything continues to
6 month?
play out. 6-month treasury bills, 3-month treasury bills, they were all significantly lower than we were told by the federal government. Here's the data, the estimations that were given to us from CBO. These were year-by-year forecasts and projections. They were projecting that in 2021, the 3-month treasury bill rate was going to be at 4.4%. What was it at actually? It was at 0.05%. They were predicting that the unemployment rate, I don't have that data up there yet. They were predicting that the PCE, personal consumption expenditures index, would be at 2%. It was at 6.4% at the time. They were estimating that the 10-year treasury note would be at 5.4%. It was at 1.25%. Because CBO is always lying to the American people, and that was directly from their budget and economic outlook for the fiscal years of 2011 through 2021. Let me pull this up here. This all boils down to the fact that everything we've seen from Janet Yellen and the Federal Reserve is a bunch of bullshit. I've got one more for you. I've got one more poem, just for kicks, right before I get off. Because I'm enjoying my place in my short position very much. In my long position, I meant to say. And I've got these shorts trapped. The Trapper of Shorts by the Butcher of Wall Street. In the world of stocks and trades, where fortunes can be made or lost, AMC stood tall amidst the trades, with its value ever on the cost. But there were those who did not believe in the strength of this great brand. They bet against it with great conceit and sold it short across the land. They thought they'd make a quick buck by bringing AMC down low, but little did they know the luck that would soon upon them show. For the AMC army rose in force, determined to hold on tight. They bought up shares without remorse and caused the shorts to take flight. The price began to rise and soar as the shorts scrambled to cover their bets, their losses mounting more and more as the AMC bulls caused much fret. And so the trap was set in stone for those who doubted AMC's worth. Their shorts were trapped and they were shown the power of the market's mirth. They fought a long battle for years and years. AMC became profitable against the odds. Then the shorts realized their worst fears. Retail became wiser with help from the gods. The cost to borrow skyrockets. Retail holds on to fight. As shorts drained their accounts and pockets, investors showed their might. For in the end, it was the believers who held strong and won the day. And the short sellers, with their deceivers, were left to rue their foolish way. Ladies and gentlemen, I ain't selling till they fire Janet Yellen. Plain and simple. I'm not folding until I'm holding until Citadel's folded. I fucked that one up. But who cares? You've got it here. I posted it on Reddit for you guys. I'll keep on going until they jail Steve Cohen. I'll be staying long until they admit the price is wrong. And when it's all done and I'm rewarded for having waited, I'll use my tendies to make Chicago sophisticated. Thank you very much, everybody, for joining me. It's been a whole lot of fun. We've got everybody hanging out here in the think tank. Everyone's been pretty quiet today, which is all right. I understand. Ladies and gentlemen, at the end of the day, I still know I'm going to be filthy fucking rich off of this. Where are you going to be? That's for you to decide. Manuel asks, how's your AMC 1 basket doing? I have a lot of AMC 1 call contracts, my friend. A lot of them. Probably 1,000. To go along with my tens of thousands of AMC shares and APE shares. Hey, thank you guys in the chat. Chicago's in the house, it looks like. Hey, you know what that means. I gotta go.
To the basement.
Yep, tornado.
Be safe.
Fuck it.
Time to get out, bro.
Fuck it. Have a great day, everybody. Have a great weekend.
You too. Happy weekend.
Thank you, guys. Wish you peace and wealth. Stay strong, my friends.
You too.
Get the fucking money printer out, Jerome Powell. Gonna be so goddamn rich.
I think it's time to blow this scene. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
Yellen, give me the fucking money. Get the goddamn money printer out. Just want to say thank you, Bookman, for the super chat. Bless you. Bless the think tank. Much appreciated, my friend. You're too kind. Thank you to MC. Thank you to Grandpa Bonnie as well. You guys are too kind. Have a great weekend. Have a great day, everybody. Wish you peace and wealth. We're gonna be so fucking rich. Get the goddamn money printer out.